Okay. I got a feeling that the internet is much better today because yesterday after the session I checked and it was running very, very slow. I did few things. Hopefully it is much better this morning. So everybody can hear me okay? Okay. So technical, we will start with the technical indicators. These technical indicators are basically mathematical calculated indicators. So I normally call them mathematical indicators. Many people call them a little bit different ways. Some they call them oscillators, some they call this, but they're all basically based on the mathematical calculation. Everybody have different algorithm for those calculators. Those indicators. So what we're going to do, we're going to start with the moving average, MACD, stochastic, and there is another one which I haven't mentioned on this, which is the ATA, average true range. These four indicators will help us to identify or to confirm the trend, what we can see in the price action, what we have learned yesterday. So we start with the moving average. Yeah. Okay. So we start with the moving average. The moving average is nothing more than but a sum of multiple periods divided by number of the periods. Important types are simple, exponential, and so there are two types which we will focus, simple and exponential. There are some other types, for example, weighted moving average, but our focus mostly will be on simple and exponential. I normally use 10, 13, 21, 30, 26, 50, and 200 moving averages. The EMA stands for exponential moving average, and SMA stands for simple moving average. The difference between the two is simple moving average is just sum of the multiple periods divided by number of the periods, where EMA is a little bit more focused on most recent periods. So it's put some kind of weighting on the most recent period. So for example, if you are running 200 EMA, it will still calculate 200 EMA, number 200, whatever the price is for last 200 bars divided by 200, but it will put some weighting in the most recent period. So it's a little bit more relevant, I would say, than in the past. So I will, after those mathematical indicator, I will go to the chart and then I will show you that's how I use them, how to plot them into your chart, and then it will make more sense to you guys. So at this stage, we are just focusing those two type of EMAs, simple and exponential, and important EMAs are 10, 13, 21, 30, 26, 50, and 200. These color, what you can see, this is how I actually code my indicator. The reason why, because when I see this color coding, I can see straight away like which EMA I'm actually focusing or using at the moment. If you want, you can use your own color coding, or you can just use simple what I'm using. So it's my just personal preference. Everybody have their own preferences. So it's nothing hard or soft. So you can use any EMA or any color coding do you like. Every currency pair, they react differently to the different moving average. Sometimes you will find that Euro USD is actually reacting to the 50 SMA, and you will find that sometimes it's reacting to 200 SMA. You will also find that Great British Pound and USD, they always react to the 26 or 30 EMA. And you will find that some other currencies, they may only react to the 21 EMA. The first thing what we do in the morning when we put those EMA on the chart, and we just try to find out which EMA a currency pair at that time is reacting. When I say reacting, reacting means that it's bouncing off that EMA, bouncing upwards or bouncing downwards. That will help you to identify the trend of the market. The another important point to note that all moving averages and all mathematical indicators, they are lagging indicators. The reason why they are lagging indicator because they're based on mathematical calculation, and to do your mathematical calculation, you need the data. The data you can only find when the events has already happened. That's why they call the lagging indicators. What we learned yesterday in the price action, like trend lines, support, and resistance, these will call leading indicator. That actually can help us to identify where the price is moving. Combined with the leading indicators and confirming the move of the price action with the mathematical indicator, this is one of the probability which you're going to increase for a successful trading. For example, if the price is bouncing back to your trend line, and at the same time, one of the moving average is touching that trend line and the price, so now you got a double confirmation that that's very strong resistance support point. At the same time, if you see some setup bar up there, like the reversal bar or bearish reversal, a bullish reversal, so you got now three probabilities that yes, these particular spots is very, very strong and price will bounce back from there on. Sometimes you find maybe 3 or 4 confluences where all those indicators and these different tools. Sometimes you find only 2 or sometimes you find nothing. So all those tools which we are discussing, they only help you to increase your probabilities and reduce your risk. MACD is another indicator, moving average, divergence, and convergence. That's what it's called. It's actually, this calculation is very, very simple. You can see up here those histograms. These bars are the difference of two moving average, 12 and 26. When you draw the two moving average, 12 and 26, the gap or the distance between these two, they represent by this bar. The 9 is the moving average of this histogram. So 9 is the moving average of the distance between these two, and it is the moving average, so this one. So people use MACD in various different ways. Some of the ways they use it like, so let's understand first the structure of the MACD. So you can see here, this is the zero line up here, and you can see some histogram bar on the upper side, some you can see on the downside. And then you can see this red line, which is the moving average of those, the difference of these two, 12 and 26. What happened that people actually use this on the different ways. They can see that if the histogram is above the zero line, they see this one as a signal to buy. When the histogram is below the zero line or move or across below the zero line, they see this one as a selling signal or shorting signal. This is the one way people actually use, and this one is very common in the stock market. Another way people actually see this MACD is that they see the signal line crossing above and below zero line again. The third way, which I use in one of my techniques, when I see this histogram is above this red line, this indicates me a buy signal combined with some other indicators which I put like some moving average on my chart. So for example, if a moving average of 5 or I think 8 crosses above the 15 and the histogram is above the zero line, then this is my buy signal. As long as it's the zero, the histogram is above this signal line, I will continue my trade on the keep my position open. The minute it goes below, I will actually close my position. So like this one, so I will actually enter my position here. I will close my position here. But this one works in conjunction with another indicator, which is 8 EMA is crossing above or crossing below 15 EMA. So when I will go into the chart, I will show you how it works. Another way to use the MACD is very common and very, very powerful. We can see the divergence and the convergence. What I mean by divergence and convergence, let's say your price is moving upwards and your MACD is showing a slope downwards. What does it mean? That's this one up here is going to break down soon. When you see this kind of divergence, you need to pay attention. You don't have to go into the order, but you need to be very, very careful, and you need to pay attention that any time the prices will reverse. It's not an indication for your divergence and the convergence. Sorry, it's not your indication for buy and sell, but it's your indication to become a bit cautious, and the prices will reverse, so you are ready to buy when it's reversed.
Shams, Mr. here question. You said that this is all data in history. How we are making decision on history?
Because the calculation of no, that's fine. Because what's happened, that's the history actually, this data history is telling us that the price is this way going, and someone trying to play up the market to push the data up so they can actually capture those innocent traders. So what's happened when you see this going upwards and upwards, that will tell you, and this one is going down. The history is telling us that the trend is downwards, but someone is trying to push the price up so they can actually suck all those traders. And once they suck all the traders, they bring the price down. Make sense?
Yeah, thank you. Thank you.
We will see this one in action very soon. So let me just set up that, so I think you more understand as we go through. So I will end here and I will start my I'm coming just while it is starting in a second. Okay. So, getting started. Okay, so while it is starting, go back to MACD. Now, the parameter for the MACD 12, 26, and 9, they are the standard parameter, and they are good enough for whatever we are doing. What does it mean? That is simply take the moving average of 12 days, 26 days, and the 9 moving average of the difference between these two. So, okay, still loading. The another indicator which I normally use is stochastic. Stochastic is simply an oscillator between 0 and 100. Normally, this indicator I use when the price is on the sideways market. I mean, it's not trending up or trending down, and it's bouncing between the support and resistance. Then this indicator helped me to give me an entry point and an exit point. Normally, if the price is at the support, and if it is above this 20 line, that's my entry signal. When the price actually reach at the top and coming back and come down to the 80, that's my sell signal on stochastic. But this is only in the trending market. Okay. So as I said here, it's a useful the range bound market. It will never work in the trending market. So don't try this one into the trending market. The standard parameter, you need to again work out based on whichever the currency pair you are trading. You need to try 538 or 838 and see which parameters are reacting to that indicator and just use that one. So I think that's start now. So let's lodge MetaTrader. Okay, so the way everybody knows how I set up this chart, so let's put the indicators first and see how they are reacting. So I will remove all those indicators. Delete, 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 and delete. Okay, and then close. And then you just simply go here, moving average. So first moving average you're going to add is 10 and 13, 10 or 13, either one. So 10 and exponential, and what's the color up there? We got red, right? Red, and this is your moving average. Okay. Okay, I have this file. I will share you later sometime after this. During the break, I will share you that file. Right, so we got here that's 10 moving average. If you want, you can use the solid line, or if you want, you can use the dotted line. So it's completely up to you. So I'll put a back up here at the dotted line. Now the second indicator I want to put is 21 EMA. So again, moving average, 21, and the color is yellow, gold. Okay, so gold, and this should be the close. This another thing I want to tell you, that the moving average methods are here exponential and simple. So I normally use simple and exponential. You can also use the other one. It's allow you to apply this moving average to the different pricing. So close of the price, close of the bar, open of the bar, high or low, or median, I mean high, low divided by 2, or typical price, high, low, close divided by 3. We don't use this one. We either use close, or there is a particular indicator which I will show you later on, which I use, where I use open, close, and high. So at the moment we use only close. So close. Okay, so we change this one to close as well. Close, right? So you can see the difference. This close is totally actually changed. Another indicator which we like to add is 30 or 26. So 30 exponential close, and what's the color? It's purple. Right. One more is 50. That's simple moving average, and the color I think is blue. The last one is 200. Close, and the color is green. Right. Now you can see this spaghetti of the moving averages here. The important thing, what you need to note, that's how the prices are reacting to the moving average. Now, to show you an example on the very, very recent, you can see here, this is your trading market. This is the trading. Moving average is not helping you here at all. They are all over the places. But at this point, when all those 4 moving average or 3 moving average, which is 10, 30, and I think is 21. So 10, 30, and 21, they are crossing each other. Red is crossing above 21 and the 30. And you see the minute that's happened, the prices actually start going up and up and up and up until it's actually reach and come back to your 50-day moving average. I normally, what I see when I see this kind of event, where the smaller moving average are crossing above, I wait for 1 or 2 bar, 1 bar, and wait for the retracement. So here is the retracement. My entry in this scenario, it will be here. This is where I would enter into the market. When I enter into the market here in this bar, my order will execute. It will go up, all the way up. Once it's bounced back to the first moving average, either I will exit at this place or I will exit at this place. So now we got a 3 exit scenarios here. So let's try to understand all those 3 and see what's the difference in the pricing. So your first exit scenario will be up here based on the moving average, right? That's it. Your second exit, it could be here. And your third exit can be around here. We will measure like which move actually make us the more money. Of course, the first one will make the most money. I'm just trying to show you that if sometime you miss this or that and you're still a little bit greedy, then you will make little money. You won't lose it, but you will make little money. So let's calculate them. So that's our entry. 15 pip only in 31, so it's about 15 hours. 31 pip in 28 hours, in 7 hours. 43 pips in about 10 hours. So you see, you got the signal for the entry only based on the moving average, but you don't have a clear signal for your exit. So that's why I say you have to be careful when you exit. You want to take very little risk and you just exit when the market actually goes below this 10 moving average, and then just exit the market. Or if you want to wait until they cross over here, which is up here, that's price. If they're crossing all down back here, then this is where you actually exit. Here you will make a little bit less money, but again, if its prices bounce back here, you've got a chance to stay in the market. So this is how I use the moving average. You can see here, if the prices are in very, very congested area like those, it's not going to work at all. So the moving average is good for only good for the trending market. Another thing, if you put it this way, that's let's say this one, we got our trend line, right? So it's bounced back, it's going a little bit down and then coming up. Now you see here, this area is again very congested. And here you can see that it's kind of a sideways market. So what will you do here? It is very, very important point, because now you can see that your moving average is crossing above again the red line here, and then it's going up. But then you need to actually see that's what's your entry will be here. Your entry probably around that mark, right at the top. So you need to wait for the retracement. Here we actually have wait for the retracement. You see it's gone up and then we wait for the retracement. Here we gone up, then we wait for the retracement. And if the retracement help you, then you enter into the market. If you have missed out this point, there is another point you will have to enter into the market. And that point is up here, around this retracement. You can see this market going up, and then retrace here. You can enter the market here, and from here to here, I don't think that you make much, but you will make something. So that's your entry, and that's your exit. So about 10 pip in 7 hours. Okay. Now, the 20 days moving average, 200 moving average is mostly used by institution. If you are actually planning for the long-term trade for a week or a month, it's best to use the 200 moving average on the daily chart, because many institutions, especially in the stock market, when prices cross above or prices cross below the 200 moving average, institutions have actually big order of the for the execution. So look at the daily chart, and you can see that's moving average. So if I remove all those moving average and leave only 200 moving average to understand why institutions playing that way, that will help you. So let's delete all those moving average. Right? Okay. This is a daily chart. Euro USD. What you can see, prices crosses above 200, bounce. How many days? So from here up to here, 35 days, 56 days. Right? Okay, just go a little bit more here. So that's when, as I said, the moving average always is a trend-based moving average, is a trend-based indicator. So here you can see when this big actually downtrend starts, it's actually that part here where the moving average price is crossing below the moving average, right up here. It's coming down, up and down, and it's never look back. The distance between the moving average and the prices, if it's a more, then it indicates two things. Number one, the moving average is, the trend is very, very strong. Another thing is indicate that the prices is a little bit far from the retracement. So there is a risk that prices may never retrace back to the 200 moving average. And this is a risk you need to assess when you do the trading. For example, here, you can see that it's never retraced back to the 200, but it's retraced back to some other trend line if you draw here manually. So this is one of the disadvantage of the moving average. If instead of the 200 moving average, you plot here, let's say the 100, it may actually react to that price. So there you go. It's a little bit reaction now. That's how basically you identify like which moving average you need to use. You need to use 100, you need to use 50, or you need to use 200 for to find out how, and there you go. So I normally, when I see some kind of this kind of trend, so I will actually put, I say, okay, so we are reacting to the 50 days moving average. And now my trading will be based on 50-day moving average for Euro USD until it's actually stopped reacting to that. And if I go back in the history here, sorry, the recent one, and I can see that this is exactly what's happening for last so many days. So you can see it's up, down, so it's reacting very well. If I want to buy now, if I want to actually, because the trend is still downwards, I will actually wait for the price to retrace back up here, and then I will actually sell the euro. The reason why.
Just by a question.
Yes.
So if a trend line is reacting to 50-day moving average, it's not a sideways market.
Sorry?
Must be trending up or trending down kind of market.
Yes.
If the trend line is, if the moving 50-day moving average is reacting to changes like market, it means that it is either going up or down market, not sideways market.
No. Moving average always used for the uptrend or downtrend. It's never used for the sideways market. Okay. So now let's see, for example, this Euro USD, Monday morning, how we will trade based on the moving average. Because this is what we got right now. The price is far away from the moving average. And we want to do some trading. How do we do? If I wait for the price to retrace up here and then come back, it's probably need another how many days? Maybe another 4 or 5 days before it can retrace. So basically, what's happened that I will apply my market cycle strategy or analogy and see if it's worth trading or not on the daily chart. So that's cycle 1, phase 1, phase 2, cycle 2. Phase 1 is almost completed and the phase 2 is started. Phase 2 is just started. Should I buy or should I sell? Anybody?
It should be buyed.
What is your overall
It's
trend?
a buy because
What is your overall trend?
overall trend is down.
Downward. When your overall trend or bigger time frame trend is a downward, we don't actually buy, we sell. So it's very tentative. Yes, in 2-3 days, you might be able to make about 10-15 pip points up here, but you never know that the prices will come down at this stage, because, and that's why I say it's very important that your higher time frame and your trading time frame, they should be synced to each other. Otherwise, you will have a problem on that. Okay. No, but yes, okay. So someone said wait. Yes, we will wait. Okay. Now this is a daily. So I'm going to do a weekly. What is the weekly time frame? Again, downwards, right? So higher time frame is telling you that the dollar is strong, euro is weak. So we don't buy euro at this stage at all. Daily time frame, no. 4 hourly, no. Hourly, there you go. So it's actually, you can see that it's not, so 4 hourly time frame or 1 hourly time frame is not reacting to your 50 moving average, because the prices are more volatile here. That's why. So if you change this one to 100, and let's see if it's changed, if it makes sense. No. So how about 200? No. Right? So you can see, I consider this one, at the moment, the current market as a sideways market. The reason why, if I put my, let's say for example, if this is the current high up here, the 12, 3, 6, Where is the current prices? Between 2 and 4. If your prices are diagonal on the chart, that means you got a trend. If your pricing are on the horizontal or close to horizontal, then it means it's not. It's a sideways market. There are various ways you can find out that market is a sideways or market is trending. So the angle of your the diagonal line will actually tell you exactly what's happening. And I actually just use this clock analogy. So I've got a round clock here. 12, 3, 6, prices between 4 and 4, 2 and 4. That's the sideways market. It's between 3. Yes, 3 and 12 is a strong market. 2 and 3. 2 and 12 is very strong. So this is where your current price is. And you can see that this is your support, a kind of price actually reacting back here. This is your another one. And the third one is coming back this way. And yes, this. So I will actually, if I want to do some trading on this particular pair, Monday morning on hourly chart or 30 minutes chart, then what I will do, I will simply actually draw my trend line. So for example, these are my trend lines. So these are the very, very recent one. I haven't gone draw the recent. So let's say this is my very recent one. Now I can see, I can measure the pip difference between here and here is about 50 pips. So that's good enough for me to do the trading. All I will do, I will put my stochastic indicator 533, and I will watch that if the prices are going above 20, that will be my buy. If the prices are near the support line, it is not at the moment. So I won't actually do it. I need to have this and this to confirm each other. Where is confirming? Here it is confirming, right? Price is above 220, sorry, stochastic above 20, and the price is near your support. If you enter your market, if you enter the market here, you will exit somewhere around that mark based on this stochastic indicator. That's your 59 pip in about 7-8 hours. Okay, so that's how we use the stochastic in the sideways market. Let's try to use the stochastic into the trending market and see if you got, so you can have some idea. Okay, so for example, this is the trending market, right? Up here. You can see this is the low point. Your stochastic is here. If you want to enter here in the market, this point or this point, so you can see that the price is on this part here is going up and down a little bit. So you don't know you enter here or you enter here. Either way, which you enter here, that's not your area for the entry. If you enter this place, this one is also not, because it's also in a downtrend in your down cycle. So cycle up, down, and then it's up. So your buy should be here, and which is again, as you can see, the stochastic showing you up around here. So that's why the stochastic, you can never have any indication from stochastic in the trending market. For the trending market, you either use the trend line or you use your moving average. Now you can see here this moving average, what we got, 200. So if we remove this moving average to change it to, let's say, 34. 20. So you can see this 20 is going sideways, right? It's maybe that's 50, which it's actually reacting. Yeah. Now, the problem with this moving average is that, as you can see, that every currency pair in every time frame react a little bit differently. So unless it's actually react very, very strongly with your the pair, they are actually, you can just simply use for some kind of idea, but never ever actually do your trading based on the moving average, unless you go into the long-term position. Long-term position means like if you want to stay in a position for a week or 2 weeks, then you use the moving average, which is about 200 moving average or 100 moving average, prices crossing above or below moving average, and you just enter into the market based on the other signals. For example, you got a setup bar or you got a reversal bar, then you are into the market, right? But even when you use this 200 moving average for cross above and cross below, make sure that you take care of your entry point as well. Do not enter until the one cycle on the phase 2 of the cycle 1 of the cycle. Let's have a look another currency. So this one is Euro Swiss franc. Sorry, USD Swiss franc. In daily chart. Sideway market, right? Straight away you can see the moving average is in between the pricing, is a sideway market. So all we need to do, we need to put our support and resistance. So that's resistance and that's support. This is very strong. As you can see, it's very strong support here. Around that mark. Now you check your stochastic, whether it's actually helping you to make your trades. So all I will do, I'll just draw those line where it's actually coming. So this is one, right? And this is two. It's actually here. This one. So you got two. In the daily chart, you got two entries. One is your right up here, and then you ride all the way back. And when you actually, it's turned back from your, when it's actually turned down, so this is your exit. So the price is going up. Oh, sorry, this is your exit. So the price is actually going up from here. That's 20. So it's coming down and then going up and going above, crossing above the 20. That's your entry. When you enter here, you stay in the market until the stochastic goes above 80, 100 and come back below the 80, which is this point. So your exit is this point, right? So now you calculate how much profit you have made. So this is your entry and this is your exit. So it's about 123 pips in 11 days. 123 pips mean if you make 100 pips, it means that's $1,000. Okay. The second entry will be here, and we see that this entry, you enter around here and you exit somewhere up here. Here. That's your exit. And that's your second order. It's a 300 pips in 14 days. So you can see how you can actually get the help of the stochastic in the sideway market. Does anybody notice in this last order something? In the last stochastic here, so around this mark. The prices actually break out above your support, sorry, above your resistance. See, this is your resistance, touching, 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 and here the prices actually break out. So this is the thing that like you need to understand. So if you missed out this point, you can actually put your entry here as well. That's a small bar. And from here on, you can still make up to 123, 228 something point. All right, so this is the stochastic, and let's go back to what do you call the price divergence. So I remove this one, and I add MACD. Right. Okay. From this point to this point, price is almost just on the horizontal, so it's not changing, right? Now have a look, the same things up here. So this was your point, and this was your another point. Okay. Here your prices is going upwards, but you see these 2 points, they are mixing, and this the same corresponding 2 points in the MACD, they are showing a slope towards downwards. This is what's happened after that. Look at that. Okay, so that's one, and let's have a look another one. So we got from here back here, and we go from here back here. So that's actually called nothing. So that's okay, that's fine. It's moving as expected. The price and the MACD, they are in sync, so that's fine. But here you've seen this one. So from this point, it's actually up. It's upward here, and they are actually equal horizontal. But on the MACD is showing the divergence, and that's why you can see after the next move, the price actually moved down. Okay, so I actually mentioned you guys that I use a specific signal which I generate a small program which called income generator, and that's income generator use a specific technique called moving average crossover and the MACD's or MACD. So I will show you how I use that one, and you can develop yourself. It's nothing secret there. It's available in YouTube. Somebody put it up there. I copy from YouTube. I just programmed that one, so I don't have to actually search for the market every time. Okay, so the moving average they use is about 8 exponential moving average. We will make it red. And he also used another exponential moving average, simple moving average, I think 18, yes. And I will color that one into purple, let's say, right. If the prices move, if the 8 moving average moves above the 18 and the price is above the red line, histogram is above the red line, then that's your buy signal, right? So just verify now this buy signal. Price is crossing above up here. So the 8 crossing above your 18, and it says that MACD's histogram line should be above your red line. So up here, your MACD is above your red line. All right. So that's my buy signal. That's my buy signal. Okay. What is my sell signal then? My sell signal or my closing position signal, when this actually, either I can wait for this MACD to cross below red line, or I can wait for this price, like the 8 moving average, to cross below the 18. I normally wait. I normally go with this one, with the MACD. The minute the MACD histogram is below the 8, I will close my position. So it means that it's telling me to enter here, and it's asking me to close my position around that mark. Also, I don't rely blindly on my program. I can also see something happening here. What? The price is actually touching a resistance and bouncing. So it means that is a congestion area. I will exit from here. So how much money we have made based on this just crossover from here up to here is about 243 pips in 11 days. Okay, so I have developed this program because I'm a little bit lazy person. I don't want to watch 28 pairs every morning or every day to tell me what's going to happen. So I hire a programmer. I asked him to develop something for me, and he did it. I'm going to actually find out during the lunch, during the first break, I will find that program because it's running in my server. I actually can show you the server. So this is my virtual machine running in Canada, where all those signals are generated. Okay, so the program which everybody can see my screen? Hello? Can you see my
Yes.
screen? Yes, okay. All right. So I have actually, because I'm a little bit lazy person and I want to automate the things where I need to do I use my minimum efforts. I have spent some money and asked a programmer to develop a small program for me. What that program does is, what that program does for me is actually every hour or 4 hour, based on my time frame which I define, it goes in the background, scan all the currency pair, and see that particular system which I just shown you basically match. If the pattern is match, it will simply generate a signal to me. It will tell me sell, buy, sell, buy. That's it, nothing more. And the programming, what he have done is actually, if you look at it, the expert advisor, and I can show you his parameters. So that's time frame, 4 hour. Every 4 hour it will go and scan 8. And here is my other one, 18. And that's it. So when it's finished, it's crossover 8 and 18, and get this the MACD histogram above the red line. It generates this signal, and the signal will stay here until the next signal is generated. And that system I'm running 24/7 in Canada in one of my virtual machine. So we have seen in our here, what was it? It's Euro CHF in the daily. So if you do Euro CHF in the 4 hourly, so it should have generated some signals on that Euro CHF. So Euro sell, sorry, USD, isn't it? Yeah, USD CHF, USD. Okay, that's not in my list of those signals. So hang on, I should be there somewhere. Yeah, it's coming, it's down. Yeah, that's the one of the problem. I can't scroll. So USD, it says it's sell signal, USD, CHF, sell signal. I don't know when it's generated but the last signal I had this one, and it's on the 4 hour time frame. It's on the 4 hour time frame. So if I go in this chart, put it 4 hour, and the last signal I can see sell signal here. You can see it's a sell signal coming down, and you can see the histogram is below the red line. So that's why it's generated the sell signal around that mark. If I would have followed this signal right from this end up to here, I would have made 28 pips so far in whatever 6 divided by 4. So that in 1 day or so. These kind of signals, they are not very good in the shorter time frame. They always give you very, very good hint into a long-term time frame like daily or whatever, or especially the daily. The another thing you need to understand when you see those signals, you still need to see the market conditions. So I can see in the 4-hour chart, the market condition is a sideways market, right? Up here is a sideways market. Before it was very strong, then it went into the sideways market, and this is the sideways market, which you actually see in the daily chart, is that portion, right? That portion you see in the daily chart, it appear here as a 4-hour. And when I see this particular sideways market, then it's when, yes, I got the signal. It's a mathematically calculated signal, but it doesn't mean that I will trade on that one. Because if it was a strong signal, something like that, yes, I would have trade on this one. But here and here, what I see on the past few bars, I can see it's kind of a sideways market. A smaller bar, yeah, signal is valid, but maybe not. We don't have too much money. Okay. So let's go back to here now. So you understand the stochastic, MACD, and moving averages, how they work and how I use them. There is another moving average which I use, and people actually ask me why I actually trade that particular way. This is I call, again, it is not a secret indicator. It's available on the Forex Factory somewhere. And when I did some of my testing, I found it very useful. So that's why sometimes I use that one. And I can show you what it is. It's called GRAB, something like that. So it's green, blue, and red, but I use it a little bit differently, slightly differently. So I delete this indicator. I delete this one, and I come back to here. So this is the indicator which I was talking. You can see these 3 lines. What I do, I normally, when I see these, the price is above the green line, that's my buy signal. When the price is actually goes below green line, this is my sell signal or exit signal. For the long, when the price is in between green, red, and blue, that's a sideways market, I don't trade. Indicator is very, very simple. 100 exponential high, so apply to the high price, top of the bar, right up here. The blue is the closing price. The red is your low price. So it's basically, I put the 3 average indicators, one for the high of the day, one for the low of the day, and one for the close pricing of the day. You can use on the 30 minutes time frame, 1 day, or whatever the time frame you want to use, and it will always help you, I can tell you. For example, on this daily chart, look at here, the price has moved down. I actually will never ever exit the market right up here. How much is it? $1,467 pip in half year, 174 days. It's a long term. But you need to be careful. This is USD JPY. What is the special characteristics of USD JPY for the long term? The interest rate in Japan is almost 0. In US is -5. Sorry, it's 0.5. It means that you are short on USD, you are buying JPY. You will pay interest difference here overnight. Unless you have an Islamic account with them, which is a swap-free account. IC Market, FXCM, and other brokers, they do offer swap-free account. But the people who will have a standard account, they have to be careful. For that long, you will pay interest 0.5% on this one, because the US interest rate is 0.5 and JPY is minus. Okay, so I delete the stochastic from here and I add MACD. I add the MACD. Now, if you see,
Can you explain this interest component again? Like,
okay,
confusing.
so the interest rate, the way the interest rate is work is you always trade a currency pair. So one country will have a higher interest rate, other one will have a lower interest rate. Whatever the difference is, either you will pay or you will collect. So for example, AUD USD, Australian interest rate is 1.5, USD is 0.5. So the net difference is 1%. If you long on AUD USD for 1 year, you will earn 1% interest rate on your position. If you are short, then you will pay 1% interest rate on your position over the year. So that's over the year is actually calculated daily.
For how long the transaction? For how long the transaction?
Sorry?
I was saying for how if the transaction is, let's say, 1 week, then you pay interest for that 1 week when you are
Yes.
long and short.
Yes.
And short, yeah.
Yeah, 1 week.
And we can also request for the Islamic account as well.
Yes, you can.
On a starting base as well. If I like, I'm a new trader.
Yeah. No, that's fine. I have actually, if you go to the IC market through me, I have request them. That's most of my client will be looking for this Islamic account. So it can, they do open.
Oh, thank you.
Okay. Now, coming back to the technical analysis. So here I can see that the price is going below this 100 moving average. This is the point. And you can see right up here is basically up. So this is the point, right? And here you can see that also your MACD is going towards down. You can see. And it's not coming back right up to here. So you see, there's a small one here, small bits and pieces here, but that's fine. And you can see that you are getting your confirmation for this one, for your entry from here, with your MACD is down your 0 line. Okay, so let's just try to tell you something else. So up here, and up here. Okay, you can see here the price is coming down here, and here your MACD is going upwards. You got a big jump up here. This is we call divergence. So you need to actually, when you look at your chart, it doesn't mean that all those things is a black and white rule, but those things will help you to understand which direction you want to go. So AUD JPY, let's see what this one says. Okay. Can anybody tell me here something? This is on the daily chart, and it's for last almost 1 year, from 18th of Feb until 12th of November.
So the buy signal is close to after 21 October, somewhere close to 10 November or something, where the histogram goes over red line and.
No, that's the history. Everybody can read the history.
The market is also the.
What are you going to do tomorrow?
I think it's a buy signal.
It's a buy signal. Why?
because the histogram today is above MACD, and the market is above the green, the dotted green line.
So what's your name? Okay, Mustang sir. Right. So you got a buy signal. Is anybody else contradict his statement? Okay, Mateen says upward trend, buy time. Okay, so now I would actually want buy on this currency pair just yet. The reason why, the cycle, market cycle is started and is almost peak. Look at here. So your market cycle starts from here and here is peaking. Can you see these two things here? Right? Remember I says you only buy in phase 1 of section 1. Your section 1 is around that one. It's not here. You already you already missed this opportunity, so just move on. Okay, you say I see a reversal candle. Where is the reversal candle, Mateen?
The last candle, it looks like a doji.
Doji is a reversal candle, but do you wait for the confirmation, right?
Actually, I wait for another candle to make a decision. So, but as you have told me that not buy, because in the first phase,
Yes.
the buying time has already passed, so I would not enter into the trade.
Absolutely right. Yes. You can people actually who are very aggressive and who take the risk, they can go reverse. They can actually enter into the counter trade, but I wouldn't do that one. Right now, just I take the screenshot of this particular the chart, and I want to show you something else on this one later on about what you call that. How we will actually deal with these stop loss, because here I can see that even if you enter your market here, there is a chance that you will actually exit out of the market. Market will take you out with this big jump, this volatility, which is, I think, the election day, isn't it? So it's up here. That's, I think, the election day. 9th. Yeah, I think it's election day, 9th of November. 9th, no, the 7th. 6th was the election, just to December. Yeah, 9th was the election day this time, right? So that's time frame. That's would actually have wiped out if you have entered in this market. And you see, this kind of thing is actually exceptional, because those events doesn't happen all the time. And remember, when the election time was coming, everybody was telling this market will be highly volatile. So close your position and watch it. So I would actually, if I see this event is coming, I would close my position straight away. But other than that, the price is actually going right upwards. And I think it's now reaching this particular phase. So it will reverse back. And let's do what's happening in the 4-hour chart. And you can see here exactly. See, this is what's happened. Right. And yes, this is the 8th November. That's your election time. Down and up. Big jump in one day. All right, so it's 10:14. So we take 10 minutes break. We will come back. I will actually close this meeting. We have to enter it, because that's the only way I can do my recording. Recording actually doesn't happen until I close the meeting. So it does the conversion after I close the meeting. So we come back into the same one.